Let's talk money.
Hello and welcome to another edition of Let's Talk Money with me, Surabhi Upadhyay. Now, quant funds have been in news of late, and they have been in focus on the back of standout returns over the last couple of years. But there remains quite a bit of uncertainty in investors' minds over how these funds exactly function. So what is quant investing all about? Well, Harish Krishnan, Co-Chief Investment Officer at Aditya Birla Sun Life Mutual Fund, is joining me on the show to help us decipher these type of funds and the mysteries that surround them. Harish, great to have you with us for this conversation. Really appreciate you taking out the time, in your busy schedule to be with us in person. But really tell us, quant has become the new buzzword. I think a lot of fund houses want to launch these funds. There are certain PMS strategies on quant. So, we really want to do a classroom 101 on what is quant investing.
Sure. Quant investing stands for quantitative investing. It's a short form. Basically, while there are a certain amount of positives that human beings as fund managers bring in, notably, if you look at from an Indian point of view, it's generally that Indian fund managers have generally avoided bad companies. So if you look at any mutual fund portfolio, in the markets, maybe out of 5,000 companies, 5–10% of companies die every year, which fall, say, 70, 80, 90% and never recover. You don't generally see those in the form of, say, mutual fund holdings. There's a certain amount of diligence that comes through that human beings bring in. But human beings also bring in a certain set of biases, right? And, we all know that we shouldn't be biased, we should be logical, etc. But the reality is, in the heat of the moment, we do take decisions which are not the most unbiased decisions.
Most mathematical of decisions, let's say.
That's right. And if you look at, between buying and selling, at the time of buying, there are multiple frameworks in which we can offset many of these biases. You can look at valuation parameters, you can look at catalysts that can come through in the next 12, 18 months, etc. But when it comes to selling, the selling decision exposes all our biases. Because technically, selling you do only for two reasons. Okay, one is either a selling induces a regret that you're selling too early or you're selling too late. It is same whether it is a retail investor or is it a professional money manager. And therefore, you don't get a very optimal kind of a decision making because of these biases. Now, if I were to flip the other side and I look at machines and, with all these advancements that are happening, can machines predict the innate greed and fear of markets? Possibly not. But there is a certain method in the madness that machines bring in, which is more importantly that they are unbiased. So rules can be created which are very clearly in terms of buying, holding and selling. This reduces the emotional aspect of taking that decision, which then results in more logical decision making. The negative of machines is, of course, in some sense, it's garbage in, garbage out. Machines really don't have the diligence to know which is a manipulated company, which is a good company, which is where you want to give a lot more time and capital to over a long periods of time.
Who knows? Maybe that changes with artificial intelligence, the rate at which things going. Maybe perceptive machines and computers that can even figure out some of these issues.
The reality is the moment you make any rule known, okay, there is enough incentive for other people to game that particular system, right? And therefore, yes, for sure there will be advancements in which we can try and reduce some of these biases, but we'll never get the diligence that a human fund manager brings in terms of ability to understand the softer aspect of a promoter, in terms of ability to judge whether this is genuinely a turnaround that's going to happen. Machines will invariably not be able to get that. So therefore, when we look at quant, okay, one approach is we can go purely by machines. Which is, you can run a whole
formula.
Now, the way the formulas got designed is, typically when you look at any particular portfolio, the way you look at it is in the guise of sectors. How much is in IT, how much is in banking, how much is in pharma, etc. And for rightful reasons, because you believe that stocks in a particular sector tend to move together. And therefore, it makes a lot more logical sense to look at it. Now, in the 90s, there were a couple of researchers in US, Pharma and French, who got subsequently the Nobel Prize for this work, which was basically that there are other dimensions also in which you can look at markets and portfolios, which can give differentiated return risk compared to the market factor, right? And they came up with what is called the factors. One of the factors that they came up was the value factor, which is companies which are cheap on certain quantitative parameters tend to perform differently from the market. Again, it doesn't mean it'll outperform, underperform. That was never their call. It's just that if you own the market, you get a particular risk reward. Owning this particular kind of a factor gives you a differential risk reward perspective than owning the market. Subsequently, other factors came in by these two gentlemen, which were primarily the size factor, which is companies which are smaller tend to have a different risk reward. Then came the low volatility factor, which is companies which have exhibited lower volatility in the past tend to be appreciated differently.
Sure.
Right? And then there was a quality factor. And then in 1993, there was an Indian called Narasimhan Jagdish and Titman, an American researcher, which came through this factor called the momentum factor. The momentum factor is basically what we see in sports, which is that, the form of a particular player extends possibly to the next match, and then it eventually dies out, right? So the momentum factor basically stays, as far as stocks is concerned, is that the past winners tend to do better than in the future. And so therefore there is a certain signal or a certain persistence of that that extends for, say, the next 1 month, 2 months, 3 months, and then it dies down. So the way machines look at it is not in the form of sectors, but they look at it factors, and rules can be created on the basis of those factors.
So this is really, important because we're going down to the absolute DNA, the building blocks of how some of these investing strategies work. You mentioned factors, and now these factors, whether it is quality or momentum, I mean, I consider them as like filters through which you can segregate a bunch of companies or a bunch of stocks. Now, the thing is that there are indices also based on these factors. Now, here in India, right, you could have a momentum, momentum 50 or a quality 30, etc. And you have passive funds then that mirror these indices. It's called factor investing, I mean, for our viewers, in case you're interested, or smart beta investing. So there's the passive element to it. But again, coming back to our subject at hand today, which is quant funds are not passive funds, right?
That's right. So there is, like I said, with passive funds, not all of them, but sometimes, you do get an odd stock that you may not be very comfortable with in terms of, what kind of a name is coming into a rule. Because everything is a mathematical rule. And any stock, for example, momentum is primarily looking at price action. Now, you could have a bankrupt company also seeing a very healthy price action as been the case. Now, ideally, would you want to really park your capital in those kind of things just because it is showing up in one such screener or filter, like you said? And that is where the human involvement starts coming in. So it doesn't mean that you cherry pick which are the ones that you don't want to.
Because then it becomes active.
Then it becomes active, right? So, but you create rules basis the past experience of human beings to try and avoid them as rules. Except that it is not coming from the machine. It's a different set of rules. All quant is saying is it has to be rule-based so that there are no biases. So you use the intuition of human beings, our experience of the last 15, 20, 30 years as to where we have technically gone wrong more often than not. And you avoid those black holes wherein typically machines can get terribly wrong. And then you put it.
So quant to me is sounding like a sweet spot in between pure active management and just passive investing, which is simply mirroring an index. It's kind of bringing the best of both together, because there are still rules. While there is human intelligence of a fund manager that's at work, there are still some rules. We have some questions coming in as well, fundamental questions on quant investing. So let me quickly get to our viewer. I think we have Anubha with us on the phone line. Anubha, hi. Welcome to Let's Talk Money. What's your question?
Hi, I'm Anubha Rao. As a retail investor, how do I differentiate between quant funds, as they have very complex methodologies that I may not have the means and the knowledge to understand?
Excellent question, Anubha. And I think, I don't know how many people ask this question before investing, but it's a very good question, right? Because now in passives, this is the underlying index, this is how this fund is supposed to function. What about quant strategies?
So ideally, a quant strategy which is transparent and gives across its processes, because there are only basically 4 decisions that any fund takes. What it buys, what it sells, how much it weighs, and how often do you run the same process again and again. So these are the only 4 things that anybody has to really pay attention to. Be it in an active fund also, you do focus on these 4 decisions. It's just that it is masked by a human fund manager who provides these answers. So as long as there is a product which explains how each of these 4 decisions are done and lays it out to you, you get a broad sense as to what the process being followed out here, right? Which may apply to, say, maybe 90-95% of all use cases. There'll always be some use cases where, because of the benefit of the fund manager, there will be some interventions, if you may. It's like saying that, you know, if I talk about aviation, and that's a great example of man-machine collaboration. It might surprise you and your viewers that in a typical flight of 72 minutes, not more than 3 minutes actually the pilot is manually controlling. The rest of the time is autopilot. And yet, you know, none of us would be comfortable in going into a plane without a pilot. There are certain edge cases, there are certain use cases where the machines can freeze, when they can get overwhelmed by conflicting data, so much amount of data. That is where the expertise of the pilot or the human fund manager comes in to handle these turbulences so that the machine doesn't get overwhelmed. Right? So therefore, you need to get a sense of both the rules of these 4 decisions, which are reasonably straightforward.
Buying, selling,
weighing,
the weightage of stocks in the portfolio, and the churn.
And the churn, and how often do you keep doing the same process. It's not very complicated. And therefore, once you get these 4, and what is the level of confidence that you have on the pilot? Who's going to intervene, and when are they likely to intervene, then you have a reasonably simple way of understanding how one...
I think that's a great analogy. So know the pilot, try and understand the flight path, and then you can perhaps board the flight. So, you know, very quickly, Harish, I'm given to understand, I think right now, if you put all quant funds in India together, I think the total assets under management may be around, what, 6,000 crores? Would that be right?
That's right.
Typically, as of now, and this is a newer industry, right? I think just 3-4 years old. So which are the major filters or factors that most quant funds in the market are deploying or employing? I mean, strategies could be different, but what are some of the key pillars on which these strategies are resting today?
Right. So almost everyone focuses on any of these 5 factors that I laid out, which is primarily you've got value factor, size, you've got volatility or low volatility as a factor, you've got quality as a factor, and then you've got momentum as a factor. So it's a mix and match. Now, the point is, it is not about how much you are weighing, you know, 25% to this factor, 30% to this factor. It is like a recipe. Right, even if I tell you that, you know, a dish has these 5 things, the reality is how these 5 are and in what stage do you include each of them matters a lot more than just providing you a cheat sheet saying that, okay, you have to take 1 teaspoon of this, 5 teaspoons of this. Still, you may get a very different dish. You know, if you try it at home, which is why like I said, if you focus on those 4 decisions, okay, buy, sell, weighing, and rebalance through the lens of any of these factors, okay, you will broadly get the answer as to how the dish is finally going to get cooked. Okay. Now, of course, in the hands of a chef, it might get cooked slightly differently. Okay, that is the human element that comes through it. But it's not going to be chalk and cheese. It's not that you're going to set up making some paneer and you get something else altogether. Right? So,
I'm loving the analogies here as well. I think they're really simplifying the whole concept of quant funds and how one should look at them. You know, we have to take a quick break, but after the break, so Aditya Birla Sun Life is also now, you know, setting up their own quant fund. And since we have you here, I want to understand the strategy, your own thought process when you're going to apply some of these, you know, rules to work. So take a break and come right back. The conversation will continue.
Let's talk money